have people hop on and chat. Let's
Okay.
see. Okay. Okay, great. We're live with James Lavish. I've been following James for a while now, over a year, maybe 2 years. And, him and Larry Lepard are his partner in the
Bitcoin Opportunity Fund. Yeah.
The Bitcoin Opportunity Fund. James is like me, an old fixed income guy. I kind of predate James a little bit, I think, but
maybe a year or two. Yeah.
Yeah, not a generation. We're sort of the same vintage.
Yeah.
And I got out of TradFi in '92. And James kept on going, and was I guess a hockey player originally. Was that you originally?
I was. I played hockey in college, and then very briefly after college, I was drafted by Boston.
Right.
I was trying out for I was on the national team, trying out for the Olympics, and then I blew out my knee. And so I spent a few weeks in camp with the New York Rangers.
Okay.
Remember that year that Messier came over, and and then they went on to win the Stanley Cup without me, unfortunately. But it was a fun time. It was great. It was great to play.
And then you got into like high yield, right? High yield bonds.
Yeah. So then I kind of made my way onto the New York Stock Exchange.
Okay.
I needed a job. It was 1994. And I was, so I am half a generation off of you, maybe.
Okay. Right.
But you remember those days. And in 1994, there were no jobs anywhere. So I went to New York City, where I had some friends from college and who had been involved in Wall Street, and they said, "You've got to come see what we do." And so I got a job on the floor of the New York Stock Exchange trading ADR arbitrage. So that's really where my that kind of base of math came into my investment kind of philosophy and style.
So just for the reference for people who don't know, ADR stands for American Depository Receipts.
Right.
And these are foreign shares that have sort of like tickets, right? They're sort of like, this represents your coat check for a stock that might trade in China, for example.
Yeah. So they're basically they're foreign shares that trade on the floor of the New York Stock Exchange. So if you think about it this way, it's like buying. So if you wanted to buy Glaxo or I don't know how some of the foreign stocks, like if you're buying, think of Glaxo is one of them. My brain can't even think of them anymore.
I don't know, China Mobile or something like
that. Or something. But exactly. So if you're buying one of those, but you don't want to have the currency exposure,
right?
And you want to buy them as if they're a stock on the New York Stock Exchange. So if you remember, these things would trade at just in a few pennies. Basically, they were trading and GBP, and they were trading in just a few pence. So you'd bundle them up, have a whole bunch of them, put them in a basket, take out the currency, translate it, and trade on the floor of the New York Stock Exchange. But the reality is they were trading in London or in Europe at the same time they're trading on the New York Stock Exchange. So you would be buying.
There's always a little bit of a difference there, right?
And there were no spreadsheets, man. We didn't have Excel spreadsheets back then. We had calculators, and this
we had quotrons.
Quotrons, yeah, and this would have been a fancy calculator on the floor of the stock exchange. It was just the biggest buttons you can get because you need to do it quickly. So and
of course, needless to say, we did not have Bitcoin. Needless
we
didn't even have the idea of Bitcoin. The idea. I mean, could you have even imagined something like Bitcoin? Like if somebody came to you and said, "James, I got this idea for a totally decentralized cryptocurrency,"
inconceivable.
You would say no. Like this is just like it's completely that's not possible, right?
Yeah, I mean, and so when I was coming on, the internet was just just solidifying. So we had the internet in college, but it was really, it wasn't the World Wide Web. It was the internet, and so you could connect. I could connect. I remember, my first wife. She was trying to figure out if there was a book in a library at University of Texas, and we were blown away because I was sitting on my computer in my room at Yale, and I was able to log on because we had the internet. One of the
You were
students
using like AOL, right? At that point?
No,
You
it was the
pre.
university
Okay.
provided
Right.
on-ramp to the internet,
Right.
but it was really just connected to a few places. It was
Right.
connected to some government agencies and to other universities. And so I was able to jump onto the Texas University,
Mhm.
University of Texas, their internet, and see if there was a book and where it was and what library it was. And she was able it blew our mind. At that time, it was like mind blowing that I was able to do that without a phone call.
I mean, it
And
is
so,
amazing to think about. I mean, I even remember before the internet, believe it or not, I remember there was this thing called DARPANet. DARPANet, right? There
yeah,
was the
DARPAnet.
it was the predecessor to the internet. And at Stanford, we had I had a very early access to DARPANet, right? And it was really only used by a handful of universities. And I had,
That's
my
crazy.
yeah, I had one of the very first email things, and then
What were you able
AOL.
to what were you able to do with it?
You were able to send emails. That was about what you could do. You
That
could
was it.
send an email to somebody else on this DARPANet, and yeah, it did not look like it was going to go anywhere. Honestly, it looked like,
Yeah.
okay, well, this is something, for a
It
bunch
looked
of
like a fad, right? It was
researchers,
very specialized for certain people that might, it would
right?
be a specialized use case for it. But yeah, so
And
that's
I
where
will say
that's where
another thing like that, which was kind of an old crazy story, was when the internet domain, I was involved in the internet domain space for a long time, and I owned I started a company and we owned 26 top level domains, right? So
Mhm.
.law we owned, .london we owned, .vip we owned.
Wow.
But so I know the top level domain space, and I can tell you that when the internet launched, nobody thought that it was going to be used for commercial activity. So the .com domain was very controversial because they were like, "Wait a second, you want to have something for a .commercial? Why?
Right.
Nobody's ever going to use the internet for commercial things." People are like, "Well, maybe somebody's going to sell something on the internet." They're like, "No,
No way.
come on,
Nobody
no
would
way."
ever put the credit. Yeah, and so
Yeah.
flash forward to 1999, and I had a manager who was 1998, 1999, who was shorting Amazon all the way up,
Oh, yeah.
just vehemently opposed to the idea that people would actually put their credit card online.
Right.
And so, yeah, and that he ended up getting his face ripped off.
So,
But
so things change. I mean, like, you live long enough and you see these things that just do not look like they can possibly happen, and they happen. And I think that leads us to Bitcoin, because when we see Bitcoin, and I think everybody approaches Bitcoin the same way. They first look at it and they're like, okay, this kind of is a joke. There's going to be other versions of this. This is like, MySpace before Facebook, before something else, before TikTok. We're going to have new versions of this. This is just one piece of technology,
that's right.
but
That's
it's
right.
not. But it's not,
That's right. It's hard for people to wrap their. I think for most people, when I've been talking to them, Fred, and especially people our age,
Yeah.
okay, so or older, the hardest part for them to get is the decentralization. It's very difficult for them to get their head around that, and I think it's because of what we just talked through about intranet, internet, connected spaces, having people connected 24/7. You know, my kids literally cannot exist without this device. And you remember back when we had phones actually in our houses that were plugged into the wall. Now it's just the internet that's plugged into your wall. But I think that's the hardest piece. It's the hardest piece for people to wrap their head around, is true decentralization and nobody overseeing it. Because the questions I keep getting asked by older generations, by baby boomers, typically are what happens if the head of Bitcoin decides to change the code. What do you mean there's no head? Who updates it? How does it work? It doesn't make any sense to me. It just they just can't compute true decentralization, and that's, but once they get past that, then it starts to make sense, because then they start to understand that it can't be controlled by anybody, and that they can act, it's governed by, and you love this because you're the math guy, it's governed by math and math alone. And that is once they get to that point and they trust the math. It's a difficult thing when you show them the algorithm, because it's hard to pull that apart. But we have all the the keys now, the Bitcoin algorithm for dummies key, and it's actually not even for dummies. I mean, I wouldn't have understood it until I studied it. So it's
Well, I think
understandable.
the other thing with respect to people of our vintage is this: it's like, we're generally speaking, we've kind of made most of the money that we're going to make, right? Like, you're not going to get, you don't have 50 years of career in front of you, right?
Yeah.
Like you did when you were 20, right?
Yeah.
And I mean, you may not be completely over to the trash heap quite yet, but you realize when you're over 50, let's just say, right? You're most of your earning power is behind you, right? So then you really go, well, what if I'm wrong? What if I'm wrong about this Bitcoin thing, right? What if I don't? What if I pick MySpace or Friendster, and I don't pick the new one, right? Like, so I think it's very rare to find people our vintage who say, you know what? Not only I understand this, but I'm going to put a very big percentage of my net worth in this. I think you get people to say, you know what? I kind of get it. I kind of like it. But I'm not going to risk even 10% of my net worth on this thing.
Well, and that's the thing, is that, and that's a great hurdle to get over, right? And so that's how I start walking people through, and once they understand, okay, decentralization, the money is broken, they all admit that and they agree with it. They don't have as much risk to the loss of earnings and loss of purchasing power, because of what you just said. They have a bulk of capital that's already put away. They own assets. They're not too worried about it. They have real estate. They have gold. They have art. They have whatever. And they have their stock portfolio. But when you get them to say, okay, look, if I'm right, and we are headed toward a debt spiral, and this is cataclysmic. Okay,
Right.
this is not, and even if it's not in my lifetime, even if it's not in your lifetime, it's in our kids' lifetimes. It's definitely in our grandkids' lifetimes, right? So one of the things that Bitcoiners like to point out is, like, gold was it was the currency, and it was the store of value for thousands of years, 5,000 years plus, right? So, and then you've come to this almost just a strange window of fiat currencies. It's tiny. It's
Right.
it's a couple hundred years that we've really been using ledgers, really, or less, and then being completely off the gold system for just a fraction of that. And then now you've got Bitcoin is the system going forward. So if I am correct and this experiment fails, which it looks like it's going to fail spectacularly, and it's because of the way that fiat is set up, and in the incentives that are driving the money manipulation and the inefficiencies. And so if I am correct, why wouldn't you just put 1, 2, 3% of your portfolio in it? If I'm wrong, if I'm completely wrong, no harm, no foul. You lost a few percent of your portfolio. You're still doing great on the rest of it. But if I'm right, well, Bitcoin will be 100 to 1,000x of what it is today,
Mm-hmm.
which means that 1, 2, 3% will not only just save your entire portfolio, right? Or it may double or triple it if I am correct, and your kids and grandkids will be taken care of, and they won't be starting completely over with a reset. Because what's hard for people here in the United States to get their head around is that we see resets all the time. in Latin American countries, in African countries, because their fiat systems fail and they have to reset their debt. And they reset their currency. And who suffers? The people without, the people without assets, the people who are just the working class, they suffer. And so we haven't had to deal with that here because we're the global reserve currency and the global reserve asset by extension of that.
But it does appear, and look, I was with you for I was with sort of the conventional, we're okay, it's not our problem, till about, I think till about COVID, right? Even through the 2008 crisis, it looked like, okay, well, we printed a bunch of money, we did QE, we're gonna be okay. The debt to GDP was at about 100%, then 90%. But this last bit, right? This last bit just seems like we've gone in sort of new territory, I would say. So I would like you to really, frame what. Why don't you frame what happened from kind of the great financial crisis, right?
We can go back further. Let's go back a couple generations. Let's go back a couple generations. Yeah. 1987. We have the market meltdown, right? The Black Monday, and I was in high school at this time, and I saw a bunch of wealthy friends. I mean, I ended up being at this school because I was a good hockey player, but I was not wealthy. I was embarrassingly, the stuff I dressed in compared to them. But let's put it this way: I wasn't invited out to Martha's Vineyard. But I saw them, panicking, and they were scared. And so, and Greenspan comes out and he says, "Don't worry, I've got the markets back." And he didn't do anything, but he said, "Don't worry, I got the markets back." Markets, they recovered swiftly, and we marched right into the 90s and got out of that great inflationary period. And we marched into the 90s, and then you get into the internet period. We have the internet bubble, which was troubling, but go before that. So where this all really began. So you had Greenspan say this, but then when this really all began was in 1998, when you had that monumental collapse of long-term capital management. And so
my ex-boss.
Oh, really? Which one?
John Merriweather.
Okay. Yeah. So
all those guys were my friends, every one of them. Okay. And look, it's almost a miracle that I didn't go there. The only reason I didn't go there is I took a job at Greenwich Capital a year before, right? Which is right next door. I was at 600 Steamboat Road in Greenwich, right?
Well done. Nice out.
Yes. So I would have been LCCM guy, but look.
So this story, but I'm going to just give the high points for the listeners.
Yeah.
So they were shorting volatility. That's in all term, we're not going to get into the specifics of the things they were doing. They were making trades that were extremely similar or exactly the same as the trades that we were making at my firm, Carlson Capital, which was at that time it was $1 billion. So these guys had $1 billion, but they levered up to over $100 billion in trades. Okay. And back then that was a lot of money. It's not like today where you need $1 trillion to be a lot of money. This was a lot of money. And so they levered way, way, way up. And then when those volatility trades went against them, the spreads widened, they got in trouble. And so they basically, they went to, I got calls actually from other hedge funds that knew us, and they knew what was going on. And they said, "Hey, do you guys use Goldman Sachs as a prime broker?" And I was like, "No, we actually didn't. We were with Merrill at the time." And they said, "You better get out because this is a problem. They're going under." Well, Goldman goes into the New York Fed and they say, "Hey, we need help because we're going to go under because of these guys." And so the New York Fed engineers a bailout for long-term capital management from the other banks, right? So that's the first time we had kind of a real big bailout, and it basically saved the fund. There was so much contagion in these derivatives that they had. It would have been calamitous financially in New York, and then it would have reached out to the rest of the world. I mean, you remember this. So that's really
if you haven't. Oh, there was two moments like this. One of this, and then the other one was sort of this sort of Shearson, Lehman moment, right? Later.
Yes.
But we've come close to a nuclear Armageddon of the financial system, as you're about to point out several times, right? So this is the first
engineered bailout. Yeah. Right.
Mm-hmm.
And so then you go to the financial crisis. Everybody knows what happened in the great financial crisis, where the Fed and Treasury team up for the first time and actually enter the market and buy bonds, both Treasuries and mortgage-backed securities, in order to shore up the markets. Why do they do that? Well, they need to keep the Treasury market liquid. Why do they need to do that? Because we run on deficits and we need to keep borrowing. We must keep the Treasury market liquid, right? So, and that's where we started with, what was the total number from the great financial crisis that we printed? Do you remember exactly what it was? It was a fraction of what we did. It was $1 trillion ish, right? So
yeah, and it seemed like just a crazy high number at the time. I mean,
at the time, it was mind blowing that we couldn't believe that they're going to print this much money.
But now it's like you do that overnight. Oh, another trillion.
Another trillion. What's a trillion here, a trillion there?
Yeah.
So, and then you flash forward to COVID, and they printed not just under 1 trillion, but they printed over 5 trillion. And they stood there in the market with these with their basically with these banks, their primary dealer banks. They stood there in the market and just bought and bought and bought and bought to keep.
And they were buying not just government bonds. They were buying Apple corporate bonds. I mean, Apple computer,
anything they needed bonds. To inject liquidity into the markets. And so, but you remember, and this is an important part that that I've talked about before, is that you remember that in September 2019, just before all this, the Treasury ran into trouble that in September of 2019, when you had tax payments due. So the corporations were building up their reserves for tax payments, and they weren't entering the market and buying treasuries, right? And so and they were using the repo market because they needed cash. Mm-hmm. And then at the same time, the Treasury decides to dump a bunch of bonds on the market because they needed excess borrowing at the end of 2019. And so we enter this period where you've got excess borrowing, you've got a decreased international and foreign demand for bonds. At the same time, we have the tax payments due, and the repo market spiked. So repo rates spiked. And so the Fed had to step in and inject liquidity into the market in September of 2019 just to keep the market going, because it was dysfunctional. And they were worried that they could bump against a point where you had effectively have a Treasury auction fail, which you can't have. So that's before COVID. Right. That was before COVID, and before we had all these problems with the debt and excessive leverage. But now we're in a period which is what we have entered the debt spiral. We've talked about it. We've heard about it. We talked about it back in the 80s. Ronald Reagan talked about it. Debt is a problem. National debt is a problem. But back in the 80s, debt to GDP was 30%. Right. Now it's 130%, And so to get people's brain around this, we are spending.
I remember back in the 80s, we talked about $100 billion deficits. Remember that term?
$100 billion.
People like $100 billion deficits.
Now we're on multi-trillion-dollar deficits. We're on a run rate today of $2.2 trillion deficits this year.
Now, admittedly, the dollar's worth a little less than it was in 1980, but it's not worth 10. It's worth half. It's like you're not comparing apples and oranges. You're comparing a big apple to a little smaller apple, right? But exactly. We really have gone 10x in terms of the size of these. Inflation adjusted, we've gone 10x in terms of the size of these deficits.
Yeah,
since 1980. Which at what point they were already crazy.
Yeah, it's
And so
insane.
it's gotten normalized, right?
It's
So
it's totally normalized. People think this can go on forever. Well, and it does go on, and it goes on. And so let's just walk through the debt spiral for your listeners in case they
yeah,
haven't heard me speak about it ad nauseum. But
totally.
basically, if you looked at the U.S. Government, and if they were a company in the New York Stock Exchange, and I know they're not, they don't have to abide by the same rules. They have a money printer, but that's an important part of this. If they were a company in the New York Stock Exchange, you call them a zombie company. Why would you say that? Because if you look at their expenses and you look at the interest expense on their debt, they can't cover their interest expense after they pay for mandatory expenses. Okay, what are those mandatory expenses? So looking at the U.S. Balance sheet and what they take in, right? We're spending $6.4 trillion annually on revenues of about 4.4. Okay. So let's say 6.6 actually is what we're about to spend, but let's just call it $2 trillion deficits, right? So what is happening here is that you've got mandatory expenses that are, you've got your entitlements, which is Social Security, Medicare, Medicaid, and then that adds up to about $4 trillion right there. And then you've got defense spending, which is not, it's not signed, but those are all signed into legislation. That's mandatory. You've got to make those payments or you've defaulted, right?
Or change the legislation.
Or change the legislation. So, which they won't do because it's political suicide. But let's just put that over here for a second. Let's just talk about the expenses, the problem. Then you've got defense spending, which is not, that's not signed into legislation, but it's not something we're going to stop. These are long-term contracts with these huge defense
Well,
uh,
also,
contracts,
and
defense
not to
companies. Yeah,
derail your chain of thought or anything, but I don't know if you follow Kyle Bass,
I do.
but
I know Kyle from Fort Worth.
there you go, right? So
Mm-hmm.
I follow Kyle, and I think he's a great follow, by the way.
Yeah,
Kyle says that, look, if you look at defense spending relative to GDP, we're actually kind of at the lower end of the range,
we are. We
and
are.
we're probably, with all due respect to the Republicans who want to cut down on Ukraine spending, we're in a world where we're going to be spending more on defense, not less.
Likely. And that's not going down. So let's just table that. There's an $800 billion a year. It's not going down. Well, now you're at like 4.8, 4.7, 4.8 trillion dollars of expenses. And these are kind of mandatory. Well, the other mandatory expense is the interest on your debt, right? So that's 1.1 trillion. So now you're approaching $6 trillion, and this has not even gotten into any of the discretionary spending. So you're making 4.5 trillion. We'll have good tax receipts this year, but you're spending 6.5 plus, right? So, but you're not able to cover those interest expenses after those mandatory expenses. That's the major problem. So you're considered a zombie company. You're a dead man walking.
And right now, the interest is about $1 trillion.
1.1 trillion.
Yeah. Okay.
Net interest, it's less because we're paying ourselves through government
Right.
agencies and whatever. But 1.1 trillion is going out the door. Some of it's coming back. So the issue here, though, is that because we're running such huge deficits, that means that we have to keep borrowing. And as we borrow, that means those interest expenses are only going up, right? So, or they're not going away. And so,
Mhm.
and now we've got interest rates at over 5%. It's costly to be issuing debt now, and the Treasury knows this. And so, but they've put out periodic reports. Fred, you've seen these. The
Mhm.
Congressional Budget Office puts out reports. The Treasury puts out reports. Last year, the Treasury put out a report, and it included this chart. It showed the chart of debt to GDP, and it was just going up exponentially, right? And so the issue here is that they know that we are on this path that they can't overcome, and so they titled this chart, and they said Treasury debt to GDP or U.S. debt to GDP, and then they subtitled it an unsustainable fiscal path. I mean, that was actually out there for the whole world to see. They've since taken it down, but we've got the receipts. But they was out there for the whole world to see, like, and they've said it. The Treasury has said it. They're sending up warning bells to Congress. Stop spending, and you've got to slow it down. And so even Powell was on 60 Minutes about 2 months ago, 6-8 weeks ago, something like that. And he said, he admitted, he said, look, we don't work for the Treasury. We don't get into their business, but we do work for the government. We do work for Congress. Basically, we answer to Congress. And he said, we are on an unsustainable fiscal path. And he admitted it. They know it. They all know it. So so what are your choices? So going back to your point, right? What are your choices?
We've just elected you, James Lavish, as president of the United States.
Your choices are,
what do you do, James?
Yeah, you have austerity. You cut spending. Well, that's political suicide. Neither party is going to do that. We know that the incentives are not aligned for that to happen. So they don't want to lose.
Bad idea. Give me a new idea.
They've got to keep spending for their constituents. Bad idea. It's not going to happen.
Right.
Okay. The second thing you do is you can raise taxes. I hear this all the time. Just raise taxes. Just raise taxes. It doesn't work. The reason it doesn't work, you go back in history and look at taxes raised on in countries and communities. What happens is you wind up taking money out of programs that are investments in those companies, in research and development, in profitable lines of revenue. And so you wind up decreasing productivity, which means that you're getting higher taxes on lowered productivity. You wind up at the same spot. But the problem is it's even worse because now your productivity is going down. It's down sloping.
It's kind of the Laffer curve, right?
Exactly, the Laffer curve for your
Reaganites.
Yes, yeah, exactly. And so Arthur Laffer. So that's what happens when you do that. So that's not a good plan. So your third plan is to just issue more debt. And that's what they've been doing. But what's so essential about that third plan is this is where the Fed comes into play. So the Fed has two mandates. The Fed has a mandate of stable prices, right? Which means constant inflation. You can hold that there for a second. And they have full employment. Those are two mandates. And they're trying to balance those two mandates. Okay, so what does it mean, stable prices? What it means is they have this mandate to keep inflation at 2%. Powell was asked this and by 60 Minutes when he was talking a couple months ago, and he was asked, why 2%? Like, where does that number come from? And he gave a 30 or 60-second word salad answer that it made absolutely no sense. And basically what it comes down to is it's what we've always done. And really, if you translate all of it, it's what you can get away with. It's what but people won't know.
It's tolerable. It's tolerable. I can. If you clip 2% of my money every year, I'm kind of okay with it. And I'll figure out a way around it.
Right. And so you people just like, they get conditioned to it. I was conditioned to it. I was on Wall Street thinking, 2% that's the right inflation rate. You need that for the expansion and productivity. Bullshit. That's not true. It's absolutely not true. And so what happens is what they're doing is they're engineering this extra tax, and they're creating nominal GDP growth with, not inflationary adjusted, nominal GDP growth, which makes dollars cheaper, so that when they go to pay down that maturing debt from 10 years, 20 years, 30 years ago, they're paying it down with dollars that are worth a fraction of what they were before. So it enables them to keep this charade going. And this is the debt spiral. But eventually it catches up where that spiral just moves out of control because of things like breakdowns in systems. You have COVID, you have the great financial crisis. Who knows what the next black swan is? But when we have it, we're not going to print $5 trillion or $6 trillion. We're going to print 12 trillion, 15 trillion, 20 trillion dollars because the leverage is so great in the system now that's what it's going to take in order to keep it all going. And
so if you have to I think we get the general picture. We're printing more money. The only option is to print. That's the only option, really. The only political option, right?
That's
kind of, as Larry Lepard says, you're going to print till your eyes bleed. I mean,
Yeah.
Basically what you're going to do, right? Like
you don't have a choice. And why do you not have a choice? Because if you listen to Lynn Alden, I agree with her 1000% on this.
Yeah.
And you look back, no country that issues debt in their own currency that they can print would ever default. Why would they do that? They wouldn't do that. What they'll do is they'll print more money, they'll debase the currency, and they'll pay back the debt with cheaper
so
fiat
it doesn't feel like this is going to be a slow-mo death spiral, though. It feels to me like
you and Larry are on this. You believe that this is going to just accelerate. I do believe it is accelerating. However, I'm a little bit more tempered in that. Maybe it's because I'm a few years younger than you, but I'm a little bit more tempered in that. I believe that it takes a long time to break down the confidence in such a system. So remember, you talk to anybody. We're in this 24/7. We're thinking about this all the time. We're thinking about Bitcoin. I'm thinking about gold. I'm thinking about how these things are protecting us. And I do believe that long term, these are tremendous. They're tremendously important, extremely important to protect your wealth long term. Okay, and or just any savings. But it takes a long time to break down confidence. You've got an entire world that basically has been operating on dollars or accepting dollars for many decades now, 50 plus years. And so it's deeply ingrained in people's heads. So even when I talk to friends around here who hear me talk about this, and immediately they say, yeah, but if I save in Bitcoin, I'm going to eventually have to turn it back to dollars anyways. And it's so difficult to get out of that mindset of I need dollars, I need dollars, I need dollars. You don't need dollars. You need to have something where if you're expending your energy and you're getting compensated for that, whether it's through your own company or somebody else's company, and you're being compensated for that, and you don't want to take that compensation and spend it immediately, how are you going to store that without it melting away? Right. And this is the difficult part for them to get their head around is that, well, they say, well, I just put it in the bank and I make interest on it. Okay, let's say, what are you making interest on? If you leave it in a savings account or a checking account right now, you're making 0.01% on it. You're losing whatever the real inflation rate is right now on your money. But even if you put it in a money market account and you look back, so money market account is giving you somewhere around 5% right now, the good ones, right? Okay, great. CPI is less than that. I'm making money. Are you though? Because if you look back from 1971, the real inflation rate is closer to the expansion of the money supply, which has been over 7% annualized since then. So you're actually losing money. So this is why.
Plus you have to pay taxes too.
Plus you have to pay taxes and all of the exactly.
Right. So I mean, the way I look at it, really simple. I love these little back of the envelope calculations. So like, put your money, option one, put your money in the bank. Great. You make 5%. Great. Well, after tax, you make 3%. If you're in the top tax bracket, you make 3%. Great. Awesome. What's inflation? Inflation is going to be 7%. Great. After
now you've lost 4% of your money. So
every year. So you're basically in 10 years, you've lost half your money. That's number one.
More. That's right.
Or more. So you've lost every 10 years is a shift too.
That's right.
20 years, you're down to a quarter of your money, right? So
right. And people say, well, yeah, but your wages are keeping up.
Well,
okay, but even if your wages are keeping up, which they're not, but even if they are on average, they're keeping up, then you
about that. But yeah,
you still have to have a way to save your assets, right? So, and that's at least she's protecting. That's
stop. Sorry about that. I have a leaf blowing guy outside.
Yeah.
Go ahead.
At least you have a watchdog. So
yeah, I do.
And that's hard for people to wrap their heads around. But once they do, I think, and this gets us to the point of why these ETFs are so important, because the ETFs, the Bitcoin ETFs help the boomers, the baby boomers, especially with the mindset of being able to buy something that they can relate to. They can relate to stocks. It's very relatable for them to go and buy a gold ETF. Not the best way to buy gold, but if you have to, if it's in your IRA, it's pretty much the only way you can buy it. Or it's very difficult to buy it physically. You have to have a custodian.
But habits change, though. Habits change. We're seeing that right now, right?
We are seeing it, but
I remember 30 years ago, the number one stock everybody wanted to buy was General Electric. Remember that?
Yeah, I remember. Yeah, I know.
That stock is zero now. It's like,
well, it's
Jack Welch.
It's come back recently, but yeah, Jack.
Okay.
Exactly, and things do change. However, it's a good stair step for people who are not tech savvy and don't understand, don't feel comfortable with holding keys, going to Coinbase to buy it. Like I'm not going to Kraken. Like I don't understand this, and so it's so easy for them to just go buy the Fidelity or BlackRock ETF, and now I own some.
That's right.
But that's the stair step in that they can then understand it and start doing a little bit of research on it. And then they think, oh, well, maybe I really want to own this physically. Maybe I actually do want to get a
and maybe I want to, instead of owning 3%, I want to own 30%.
Exactly. And so
you kind of got to get in the game. I tell everybody, people like, should I buy now or should I buy? I said, you should 100% buy today. If you're thinking about buying, you should buy today. The only question is, how much should you buy today? But you should absolutely go from zero to something.
Zero is the only wrong answer is zero.
It's completely the wrong answer, because you need to, and I'll give you another example. My wife bought very fortuitous purchase. She bought right when the dip of the ETFs. So she bought in the Fidelity, right? And she bought IBIT, but in her Fidelity, a new Fidelity account, right?
Yeah.
And, she's like, I'm going to put a third of my money into this thing. Great. She did. Now it's gone up like, 50, 60%, right? Since she bought it, right?
Right.
And she's now like, I want to buy more. It's now cheaper. It's like, I noticed Bitcoin was at 70,000. Now it's at 60,000. You think it's a good time to buy? Because I'm really interested in this asset now. I'm like,
exactly.
I didn't even have to tell her.
The number go up technology is it's a very strong.
But you have to witness it. You have to be in the game, because if you weren't in the game, you're like, oh, good thing I didn't buy. Right? Good thing I didn't buy, because it went from 70 to 60. I didn't buy. I'm safe. Good thing I put my money in the bank. Right?
Exactly.
But you have to be in it to understand it and to have the right thought about increasing your stack. If the price goes down, if you're just on the outside, it's kind of like, it's like if you walk by the gym, you're not going to get in shape. You got to go in the gym and use the
actually go in and get on the treadmill. Yeah,
you got to get on the treadmill.
Yeah, and so but that's why this period is so interesting, because there's been a structural shift. And so, back in 1998, 1999, 2000, man, the hedge funds we were the ones who were getting those small allocations to these the massive IPOs. So when you had Amazon coming out, and you had what Netflix wasn't back then, but you had the big internet IPOs. It doesn't even matter. Most of them are gone, pets.com.
Right.
But if you got some of these, you just want an allocation. Any allocation. Right. So let's just walk through that for a second for people to understand why it is so important where we've been in Bitcoin. Okay. So if you go back to that time, the institutions were the ones who got all the allocations. And we were ecstatic if we got 1,000 shares of a high IPO, because we knew that we got that 1,000 shares at that pre-IPO price. So that IPO price of $20. Well, we knew that it was going to trade at 120. $220 that next day. Well, who was buying it at $120, $220 when it opened? Retail buyers wanted to get pets.com. They were buying it up at $80, $90, and I was getting it 20, right? I don't remember what the IPO price was, but just for argument's sake, for example. And so we were able to effectively front run all of the retail investors. Not fair. Absolutely ridiculous. Absolutely ridiculous. It's actually, thinking about it back now, it's unnerving to think of how just unethical that was. Okay. But now you go back to here and you think about Bitcoin. Well, institutions have not been able to buy Bitcoin. There's a lot of reasons for this, but structurally, it just doesn't work. Operationally, it just hasn't worked. You can't be an institution and a money manager holding your own keys, buying Bitcoin on an exchange that's not approved, an exchange that's not overseen by the SEC. You have to have a custodian that you can trust. You have to know who's trading it and have an approved trader. And like these things are just, they weren't there. They've not been there. They are still not there for Bitcoin only for most institutions. So if you're a CalPERS, you're a Guggenheim, you're a Texas Teachers, you cannot just go in and buy Bitcoin in itself. You're a portfolio manager. You've got to go through meetings and you've got to go explain to your chief investment officer what this thing is. You've got to get them on board. You've got to get the chief compliance officer on board. You got to get the general counsel on board.
Are those guys in on the ETFs yet? The CalPERS of the world, or
we're going to get to that. But
okay, great.
Yeah. So, but the point is, they could not buy. They physically could not do it. Like, who's going to? If you're a portfolio manager, one of those institutions, and you're sitting on $1 billion portfolio, you're going to take $10 million of Bitcoin as a 1% position and go home and have the keys somewhere. Where are you going to keep them in your office? Like, what are you going to, like, how does that work? It's not going to work. So they didn't do it. They haven't been doing it. And so now what you're seeing is you've got all of these institutions that have been front run by all of the retail, because we could go buy, like anybody could go buy it, and go chunk it in a wallet. They go buy it in Coinbase or Kraken or wherever they wanted to buy it, and just chunk it in a wallet. And they're sitting out. They have no problem. They can hold their keys in a safe deposit box in the bank under the pillow. It doesn't matter. It's their own risk. They're comfortable with it. But now, for the first time in history, the retail customer has been able to front run Wall Street. And Wall Street is just now getting up to speed. A lot of them still think that Ethereum and Bitcoin are essentially the same thing. They don't understand. And I'm not talking about the smartest ones who've done research. I'm just talking about the ones who are uninformed or misinformed from mainstream media, and they don't know those differences. But now they're starting to hear about it. They're starting to look into it. They're starting to, because you've got these ETFs and they're hearing, oh, wait, oh, you bought some? Oh, so is this something that is real? Is this really going to happen? Like, should I be allocating to this? And then they start dipping in. So the answer to your question of, are these institutions in it yet? We don't know. I suspect that some of them, it's not like it's a blanket thing. This. It's not a blanket thing where, oh, Texas Teachers is buying. So they've got, if they've got $20 billion, they're buying X percentage. No, they've got little portfolios. They've got bond portfolios. They've got stock portfolios. And so they may decide to add it to a certain portfolio, or what's most likely is that they own they are invested in a manager who owns it. So it's secondary, and they may not even know that they own it.
Right.
But big thing that's going to happen, I think, in the next number of months is that as these large companies have to file, they have to file with the SEC and disclose what their holdings are. And they're going to start popping up on these, the Fidelity and the BlackRock ETFs and the Bitwise. They're going to start popping up as holders of these. And then that's going to be, oh my gosh, look, they own this. And so some big names are going to be on there, and it's going to be important. And that, I think that's going to be a kind of a big second wind to the Bitcoin, price, because underlying they have to buy it. And so that's going to entice it's going to kind of force other managers.
Everybody likes, look, in the world of VCs, everybody wants, if Sequoia and Kleiner Perkins invest in a sector, everybody's like, I got to invest in that.
That's where it is. That's where it's at. We got to go. Right. You got to go.
Tim Draper once told me, he said,
I'm wearing my venture capital uniform today.
There you go. You got the fleece. Yeah. But Tim Draper once told me, he said, Fred, it's very simple the way VCs work. He goes, there's about 5 or 10 of us who think independently, and everybody else just copies every single thing we do. And that's kind of the way it works. And look, Wall Street's not that different, right, than VC. It's like, if Larry Fink says it's okay, says the water's good, he carries a lot more weight than, some crypto bro like Fred Krueger or,
It's James
whatever.
Lavish, James
Like
Lavish from the Bitcoin Opportunity
James.
Fund.
Yeah,
It's
exactly.
he as he should, because
Right.
they wield a $10 trillion sword,
Right.
so
Right.
the guy has some power. And so, I mean, look, they essentially strong armed the SEC into approving the space. So
How great is that? I mean, this is
great.
this is really. I mean, I just think that we have. I think we're in agreement that this ETF has a lot of legs. It's going to be a multi-year period. I mean, it's we're on the beginning of like a 4 to 5 year period where institutional money, managed money, but also retail stock money is going to discover these Bitcoin through these ETFs. I mean,
Exactly, 100% agree. And I
yeah,
think that what's going to happen is you're going to have a trickle, like we have a trickle right now. It's going to turn into kind of a river,
yeah,
kind of a constant stream. Then you're going to have waves of big
waves.
money coming in. I
Yeah.
don't think that we see a big, tsunami wave. I just think we see constant
Which is
waves
better, right?
coming in.
We don't want to see. I don't want to see this huge thing. Actually, I don't want Bitcoin to go to 1 million in a year, crash, and then have everybody be like, "That was the Ponzi of all Ponzi's. That was
Right.
Madoff 2.0. That was Sam Bankman-Fried 2.0. Not interested, right?
Yeah.
It's much better if it's little waves like this, and
Agreed. And I think that I honestly think that that's where we're headed. And
No, I
because
agree.
yeah,
I think that's about right. And okay, so going back to the debt spiral and stuff, though, just so what's your general thesis on the next 10 years? If you had to sort of lay out a sort of a general thesis as to does this become a major, what happens to the economy? Do we sort of muddle through this? Do we have a major crisis in the next 10 years?
yeah.
Where are we? Are we in we were okay, but things get more expensive and inflation? We add another zero to the numbers. Kind of, where are we?
Yeah,
What's
it's
your guess?
a good question. So we had the 1987. That was terrible.
Yeah.
Then, flash forward 12, 13 years, you've got the Enron debacle, you've got long-term capital management, you've got the tech bubble. Those all happen kind of back to back to back, right?
Yeah.
And so that's just 12 years later. That's a 100-year event. Then flash forward 8 years, you've got the great financial crisis. That's a 100-year event, right? And then flash forward again to another 10 or 12 years, and really like 10 years, because that great financial crisis lasted, like we were in it for a while.
Yeah.
So 10 years later, you've got COVID. And here we are 4 years in, and we're going to be due another black swan, another 100-year event in the next 5 to 7 years, in my opinion. And so what that does is it only exacerbates this problem.
Does it matter who's elected?
No. I mean, it matters in pockets, right? So for Bitcoin and crypto, to get Elizabeth Warren and her, army of insanity out of office, that's probably important for Bitcoin, and to be more Bitcoin friendly.
But regardless,
And
this
to
is the
avoid
point I'm trying to make: is it doesn't matter. Trump's not fixing this.
No, then it's
He's
not
fixing
fixable.
it.
It's not fixable. And the reason it's not fixable is because it's structurally, the incentives are structurally aligned for mismanagement and for manipulation. I mean, how else could you have senators and congressmen who make $160,000 to $180,000 a year and they're worth $100 million? How's that possible?
No.
It's not. It's manipulation and unethical and illegal activity, basically, that they've made legal for themselves.
Right.
So, but the incentives are not aligned. The incentives are aligned to keep spending in order to keep getting elected. That's the bottom line, because all politicians they're beholden to their constituents who demand certain things, and lobbyists will get they'll get a lot of spending and pork added to spending in order to.
So 10 years from now, where do you see the deficit? 10 years from now, deficit, first of all.
The deficit?
Yeah. 5 trillion?
5 trillion. Yeah.
Okay. Debt? 50?
50 trillion.
Okay.
Absolutely. I would be shocked if it's not 50 trillion. 10 years, it about doubles every 10 years, Fred. So it's probably going to be closer to 75.
Oh my God. Okay. So 75 trillion, you heard it here. 75
And
trillion over 5 trillion debt. Okay.
Let me put a caveat to that.
Okay.
What will cause that to slow down, which I do believe is a distinct possibility, and that's why I am so adamant that people should own some Bitcoin. And if you're older and you're still not there yet, you should own some gold for sure. I own both. I own way more Bitcoin, but I have a hedge fund in it, but I own gold.
I own physical gold.
Yeah, but
that's right.
The caveat to that and the size of this, that's the path we're currently on. If we continue this zero ZERP to 5% interest, somewhere in here, and we have this, inflation that is somewhere around 7%. But I do believe that we very possibly, and maybe it's probably, we'll get into a period of high inflation. And I'm not talking about 6, 7, 8%. I'm talking about 12, 15, 18% inflation. That's
1970s again.
1970s again, that perpetuates for a while. And that will help
with higher interest rates too.
With higher interest rates too.
Yes. Okay. So do you see net? I know maybe we're talking cuts in the next year, but longer term, you think interest rates are going up or down?
Longer term, I think they're going up.
Okay.
Yeah.
I'm in agreement.
I think the reason is because we've done the ZERP experiment, and now we're fighting this fire, and that we're battling it, and the Treasury knows that, and the Fed knows that they need higher structural inflation. That what are they going to be able to get away with? And reality is we're spending so much money out of government, right? So we're running these deficits. We're running $2+ trillion deficits at a time that we're not even in a recession. So Fred, when we do get a recession, you know what happens. The mandatory expenses, those entitlements, they explode by 8 to 12%. And your tax revenue.
People don't understand that those numbers are pegged to inflation, right?
Exactly. And then your tax revenues collapse by 8 to 12%. So this is 20% VIG right there. 20% delta to what we're at now. And that's in a recession. But we're spending $2 trillion and we're not even in a recession.
What about the tax rate? In 2000 or 1999, Clinton turned a profit based on all the .com revenue. Could potentially tax revenues on Bitcoin help generate a profit?
Yeah, possibly. But let's be careful what we wish for there. But
just sort of long-term capital gains.
But so this is a tricky period, and I haven't fully fleshed out my thoughts on this, and I need a few days to just sit down and think it through. But with AI and seeing what companies are doing now with AI and laying off, they're laying off people because AI is enabling them to. So eBay just talked about their AI program. Well, they're going to have higher profitability with fewer employees because of AI. Right. And so they got a big boost today from a couple of analysts for that. But, so that's not good for the typical person, but it's good for profitability. So we're getting into a funny period here, And so the question is, how much inflation is needed to continue to perpetuate this? And is it something that just occurs without control? And we go back to the 80s where it's extremely difficult to control because of either energy crisis. I mean, you see what's going on in the Middle East, or because we have enough hiccups in the banking system and in the treasury market that we have to flood the system with more capital.
Regardless of how it plays out, I think we both agree that 21 million Bitcoins is just such a bulletproof strategy for at least some of your wealth that it seems like kind of the absolute no-brainer trade. And I'd say it's not a trade, but it's a long-term portfolio allocation that I think
I agree, and you keep it simple.
Yeah.
Is Bitcoin adoption growing?
Yes.
And is it growing outside the United States? Even forget about number go up technology. Forget about being an investment. Is the use of it growing? Yes. And the reason it's growing is because of mistrust in foreign countries and foreign central banks, and the need for people to protect their capital, to protect their investment, to protect their savings. Because if you're in Venezuela, Argentina, Lebanon, if you're in Egypt, you need to have a way to save your money. You don't care that it's doing
That is
well.
most of the world, James, right?
That is most of the world. You don't care that it's volatile. Exactly. I agree. You don't care it's volatile because it's volatile and it's going up versus your currency, which is just volatile but going down, And so it's a really simple equation. So just first principles that we are in a US mindset here, and we've got to get past that. And if you get past that, you understand adoption is growing. Bitcoin saves people. It helps them. And forget about the volatility. Just buy it, hold it for a long period of time, and let it be.
On that note, I'm going to end it. I love that thing. James, where can we find you? What's the best place? Twitter?
Yeah, I'm on Twitter, James Lavish on Twitter, and for those people who don't know yet, I write a newsletter weekly. It's called The Informationist, and it simplifies one financial concept every week for you, and it's free. There's a free version of it, so you can sign up right through the link on my Twitter profile, or you can just go to jameslavish.com.
Thanks, James. It was a pleasure talking to you. And everybody, thanks for tuning in. We got 3,000 people on this thing, so I'm sure there'll be double that very soon. So thanks a lot, guys. Thanks, James. Bye.
See you, friend.